Ладно, Zoom я работаю.
Берете?
Ага. 5 минут, ладно, и начнем.
Звук какой-то странный. Сейчас. А, вот. Вот оно. Ну, всегда вас.
На английском, да, мы? А сколько людей ходит в онлайн? Сколько там? Все в офлайне? В смысле, все в онлайне, да? Или большинство в офлайне? Онлайн. Большинство онлайн, да? Хорошо. Okay, so let's speak about fixed income markets. We'll spend about 40 hours speaking about them. My name is Andrei Kulakov.
I'm sorry, is it possible to turn your microphone a little bit louder because we
Yes.
can't hear you?
Now it's better.
Oh, yes, that's great. Thank you.
Perfect. So my name is Andrei Kulakov, and well, I am in charge of fixed income research in Gazprombank, the classic sell-side brokerage research. I am doing this for the last 4.5 years. Prior to that, I worked in Troika Dialog, which later became known as Sberbank CIB, doing some DCM or debt capital market stuff, printing new bonds on the local market, on the Eurobond market, doing some rating advisory. Prior to that, I worked in several Russian banks doing, well, fixed income research as well, and started my career, well, in late 2000s, well, doing some asset management in equities and fixed income portfolios. So, well, I would say I have almost 15 years of fixed income experience in the Russian market. So hopefully I will be able to tell you something interesting about how the markets, so what is fixed income and how the markets operate. Actually, in this course, we will start with some introductory stuff today, with, well, discussion on what are the fixed income securities and what are the key characteristics. Well, I'm sure that you are, to some extent, should be, well, acquainted with general understanding what are the fixed income instruments, but nevertheless, I will try to do like half of the course a little bit academic and half of the course more practical. So we'll try to give you more color on some theoretical stuff with, well, real life practice. Later on, we will talk about the markets in general, first of all, again, do some classifications. Well, I would say that theoretical material is close to CFA level 1 and level 2, because, well, these programs are aligned a little bit. And I will then speak more about the practice of the Russian bond market. What is the Russian local market? What is the Russian Eurobond market? Well, who are the key investors here? Who are the key issuers? What are the key drivers? We will talk about the recent dynamics on the rates market, what is driving the Russian state debt, so-called OIZ. If you are, well, following the well, financial headlines, you should be quite interested in what is happening, well, with sanctions rhetoric, with all the new sanctions that were imposed, sorry, last week, for example. We will discuss all this in details. Well, I believe this is quite practical stuff. Then we will speak about, well, some, I would say, key matters on the valuation stuff, on what are the approaches to the valuation of fixed income securities, fixed coupon mostly. Maybe we'll talk about floaters if we have some time, some money market instruments and things like this. Later on, we will talk about, well, the key to, well, risks that are linked to the investments into the fixed income markets. So the first one is the interest rate risk. We will compose it into the different components, and we will discuss how each of them can be offset, what drives them, and we will talk about some, I would say, strategies which, well, investors can take if they expect, for example, well, the increase in rates, decrease in rates parallel, or, for example, first steepening or flattening. I believe this is some kind of actually quite, again, relevant topics, especially given the current situation in the bond market, I mean, the global one and the Russian one as well. And we will, well, I would say we need to finish with the, well, some talk about the credit research approaches. Well, this is not like some kind of a separate topic, but this is actually some kind of a framework how you can put your other knowledges and use them, well, for assessing credit risks in the fixed income markets. But one of the tasks which we plan to do during the course is to prepare some kind of credit reports. I would say I would better expect them to be in form of some kind of presentations, and probably to give you some time to work on them. Probably we'll actually put this credit topic somewhere in the middle of the course, but we'll see. So for evaluation matters, I believe, well, you can look into the syllabus. I don't remember the particular numbers, but generally they're evenly split. I believe there will be one or two some kind of quizzes, like well, tests in probably CFA format, like questions with multiple choices. Well, probably it will be 1/3 approximately. Please well, look into the syllabus for more particular numbers. In the total grade, well, 1/3 of the total grade will result from the final exam, which I believe will also be in a multiple choice format test. And actually one more thing is this credit report, which I expect you to complete as your homework. So as for the last part, let's maybe we'll just discuss now in few details, and next time probably you will have some questions, and we will we can discuss it in more details. What I expect to see from these credit reports, from this homework, I expect to see some kind of presentation. How many students are there in the class totally? Or active? 50? Well, a big group. So actually, then usually we do some split that, well, the students split into some groups of 5 to 6 persons. I expect you to do it, well, as soon as possible. Well, just do not spend too much time on this. Do it on your own. If you cannot do it, then, well, I will split you, because we need to have some groups. Well, too many groups this time, because actually there are usually 6, 5 of them. Now it will be approximately 10. So, and each group receives its own company. I give you some name. Well, I give you the name of the company. Well, some well, issuer who is presented on the Eurobond market, the Russian Eurobond market. The issuer who has some Eurobonds outstanding. And what we do, well, actually, you start preparing your homework, making some, well, industry analysis, making some company analysis, and making some analysis of whether the bonds of this issuer, whether they look attractive on a relative basis or not. Probably we will talk about all the matters which you need to be acquainted with within the course, well, with the exception of the industry analysis, but I actually presume that you already have some economic stuff, and you know what are the 5 quarters and things like this. So I will not put too many attention to this, but still I would expect it to be like a top-down approach. I will also provide you additionally with the Eurobond prospectus of the particular issues which we'll be discussing, and I expect you to do some, well, examine some things on the documentation side, like, well, mostly on the covenant side. And I will also provide you with the Russian bond universe, Eurobond universe, with all the bonds that are relevant to us, with the, well, characteristics like tenor, like yields, and we expect you to prepare some kind of a yield map. We'll discuss in more details what is it in, well, later classes, and to do like a relative value analysis, whether the bonds of this issuer are attractive or not. So generally, it's quite maybe enormous in terms of scope, but, well, we will discuss, and I believe you can go, well, in more details if you want, but, well, I will not, for example, ask you to prepare some financial model if you don't want. You can do it, but you are not required to do this. So this is like a general overview. Well, if you have some questions, let's discuss them later on. Well, please, Yes, we have quite a big pause, I believe, after the next class next week. We will not meet each other for 2 or 3 weeks, something like this, May holidays and etc. It will be good if you can like split into different groups by, for example, by the next time, and send some kind of Excel file so that we can start choosing companies for each of the group. Okay. That's it. Any questions as of now on this, on what we already discussed? So let's then probably start with today's overview. So if you have some questions, please don't hesitate to ask me. Let's start from the very beginning, I believe. What are the fixed income securities? Definitely these are mostly the bonds. So we will mostly speak about the bond market, and the two main things. One more thing actually, which I forgot to ask you. Is there anybody who's preparing for CFA exam? Which level? Anybody else in your group, for example? No? Those for online? Okay. Okay, I see. So for you, some part of what I will be discussing is, maybe some kind of what you have already read in the books. But again, I will try to give more color with some real life examples and things like this. Thanks for feedback. Maxim, for your request to, with this screening of the presentation. Is it fine now or no? Because I tried to do this. Okay, thanks. So in each class of financial instruments, you will actually have some like so-called plain vanilla instruments. And what is a plain vanilla is like the simplest instrument in the class, right? So when we speak about the bonds, and when I will say, for example, fixed income security, or for example, when I will say bond, what I mean is a bond, that just have a fixed coupon, which has a fixed tenor and makes some interest payments in these fixed amounts and repays the principal amount when it comes due, right? So just it will not be some kind of a floater, it will not be some kind of whatever another type of the instrument. So this will be the most easiest instrument. So we will call it bond, so just for simplicity. Let's speak about the key characteristics of such securities and of bonds. What do they consist of? So how can we describe the bond and why all these characteristics are important to us? First of all is definitely who is the issuer of the bond. You see here different categories of issuers. You see corporates, maybe including or excluding financial institutions. So sometimes, and it's actually, I believe it's quite a true approach to understand that financial institutions are different issuers from corporates. Definitely sovereigns, non-sovereign governments, or so-called sub-federal debt or municipal debt, quasi-government entities, and supranationals. How do you think, among all these groups which are listed here, who is the largest? Well, again, it depends on each particular market of each particular country, but in general, how do you think, who is the largest issuer of the debt on the global context? Definitely, why? Why government? Huh? Yes, but well, you are right. But well, there is quite an easy explanation to this. How do you think why? What finance? What? Budget deficits, I would say. Okay, but well, everybody needs to finance something. Companies need to finance well, capex needs, dividend payments, and things like this. Huh? Sure, and this, yeah, as I said, a very easy answer to this. And moreover, actually, well, the real practice is that, well, banking facilities are, well, course of the size that usually is not, well, the instrument which sovereigns use. If you, well, look into the government budgets, and for example, if you, for example, open the Russian budget, you will see that the key source of financing is the local market, is the bond market, and actually is the local market. And this is like some kind of a spoiler when we turn to the discussion on how the sanctions on the new Russian debt, which were introduced last week, could affect the Russian economy. So, but this was quite an easy question. The next one is also quite easy, but it can be arguable. Who is the second largest group among those which you can see on the slide? Guys, I see your responses in the chat. Well, generally, all of them are true. So again, quite an easy question. Who is the second largest group? Look, the Russian bond market is approximately 30 trillion rubles, and the supranationals are less than 1 trillion ruble. But actually, you're right. Well, in global context, one of the possible answers is you said supranationals? No, sorry, I meant subfederals, like municipal issuers. For example, if you turn to the US market, and it's somewhere close to $30 billion, trillion dollars in size. Well, 1/3 of them are subfederal issuers, meaning different states, cities, and things like this. This is because of the quite developed economy and the way how these non-sovereign governments, yes, how they finance the budget deficit of their own. For example, in Russia, this market is very small because the key source of financing the deficits of the regions is like transfers from the federal budget. But this again dependent on how your taxes are collected and on which level, on the level of the sub-sovereign or the level of the sovereign. But generally speaking, one of the answers which could be correct here is that the second largest group will be subfederals. But the next one, any more options? It's a good question because, for example, we will be here. It's like more academic stuff from CFA or from Fabot's book. In the, for example, context of the U.S. market, this will actually mean some kinds of Fannie Mae or Freddie Mac, like some mortgage agencies, which issue, which do the securitization of the mortgages and issue mortgage-backed securities. This is actually what is meant here. You would speak in the context of the Russian market. Mostly, it will be meant that quasi-government entities are some kind of quasi-government state companies, but actually more applicable way to assign them to the corporate group still. So in the context of the global market, it's some kind of like Fannie Mae, Freddie Mac, I would say AJK in Russia, and things like this. So this third largest group, actually, you said partly right that those are corporates, right? But actually, only part of corporates and actually, I would say financial institutions. How do you think? Why the size of the financial institutions market will be higher than the size of the corporates market? Corporates, we say, excluding financial institutions. Okay, so we have some answers. Okay, overnight lending, some answers, but I don't know. It's out of the not enough words to answer the question. So actually, because for corporates, for example, some oil and gas or metals mining companies, the operating activity is to mine something, yes, to provide some product and things like this. And for financial institutions, the operating activity is to do some finance stuff, and actually they need to take liquidity, they need to give the liquidity. So issuing bonds is one of the way how they can attract liquidity, and actually just one of the sources, including like repo financing, including deposits, including other kind of savings account and things like this. So for them, this is like a part of the operating but not financing activity, and this is what actually they do. And Maxim says that in nature they need more liquidity. Well, to some extent, this is actually what I'm speaking about as well. So just remember that issue of the bond is extremely important for us. Different kinds of risks, and what is more important, different kind of investors who invest into different bond markets, and we will speak about this in the next class. As you said, right, the key market is a sovereign market, but again, this is actually not always true, because, for example, again in Russia, the OIZ market, the Russian state debt local market, is quite big, but it's still comparable with the corporate market. Just because, for example, the Russian government is not heavy loaded with debt, and this actually why the state debt is not that big. But this is actually a question of time. But generally, the sovereigns, then the non-sovereign governments, also federal issuers, then financial institutions, and all the rest are somewhere else. So supranationals, who are they? These are bonds issued by different organizations that operate globally, and like some development institutes, for example, World Bank, for example, International Monetary Fund, European Investment Bank, and etc., etc. So the next, the second important characteristic for us is a bond maturity. So this actually describes when we will receive the funds which we gave to the issuer, when we will receive them back. A few things to remember here. The tenor of the bond is the term to maturity, actually. There could be three big classes of the bonds if we classify them by such a characteristic. First is money market securities. These are the bonds with a tenor of usually not more than 1 year. Again, it will depend on each particular market. For example, we'll speak again about this later on, but 9 to 12 months tenor is usually attributable to money market securities. Capital market securities, these are actually usual bonds, and they usually have a tenor, at the time of the placement at least, of 1 year and more. We also have perpetual bonds, which have no maturity, as it is follows from how they are called. And this actually class becomes more and more popular. In the Russian market, we saw a few deals from the key issuer, from Gazprom, coming into the market last autumn, and these instruments are quite popular. They're called perpetual, meaning that they have no maturity date, but actually they can be called. They have an embedded options, which we're gonna discuss in more details today. So actually, there are some points of time when they can be redeemed in one way or another. So the par value, it's actually some basic stuff. It's like nominal, which it sounds in Russian. It can be also called the par value, face value, redemption, maturity, principal value, whatever. Usually it is all about the same. In the bond market, in the fixed income market, and this is different from, for example, equity markets. In the equity market, you pay, for example, $50 for one share, and well, it's easy to calculate. In the bond market, you trade in terms in the percentage terms, and these percentage terms, they are well taken from the par value of the bond. So you will not see quotes in dollar terms, but you will see them in the percentage terms. So you can see, for example, a bond which is trading at 108%. So meaning that this bond is trading above the par value. Par value is 100%. So the bonds which trades higher than the par value is called to be trading with a premium. The one which is trading below the par value is said to be trading with a discount, and the one which is trading at par is said to be trading at par. Just sorry, 1 second. Sorry for the delay. So why bonds can trade above or below the par value? Okay, but it's some kind of like, it means nothing. Why will they have higher supply or higher demand? Based on what, for example? Okay, you have a bond which was placed, for example, yesterday with a coupon of, let's say, 1 month ago, with a coupon of 6%, right? And well, at the date of the placement, bonds are usually sold at the par value. It's not usually, or it's not always true, but it's usually true. So, well, 1 month passed. For example, now it's trading at, let's say, some kind of premium. What does it mean? That the rate of this bond was more attractive than rate of peers, or the rates went down. It's, well, a question actually I haven't discussed with you, but I want to hear from you first. What's your understanding on this? So what could happen? Or probably maybe company received some credit upgrades or things like this, or credit downgrades. What could be the reasons? Well, actually, everything what I said could be the reason. Huh? Well, Maxim writes that change in rates in the market. This is actually one of the possible answers. This is true because, for example, imagine like no credit risk, imagine only just rates, and take, for example, sovereign debt. For example, well, OFZ market was trading some kind of 6%. One important thing which I forgot to start with. We will see it in evaluation topic, but well, this is some essential thing that we need to keep in our minds. I believe you are well acquainted with this, but still, bond prices and bond yields move in opposite directions, right? So if rates rise, prices go down, and well, opposite is true. If rates go down, the prices go up, right? One of the things which could have happened since the issuance of our bond is that the general market rates, well, for these kind of instruments, of this kind of risk, if we speak about the sovereign instruments with no credit risk, on a relative basis at least, and so we can say that the rates probably moved up or down, right? So the rates moved down, for example, in the anticipation of, well, CBR monetary easing, for example. And what happened? Our prices go up. This is why they could be trading with a premium. What else could have happened? For example, well, we can speak about corporate bonds. Corporate bonds, well, they have not only like benchmark, they're not moving only following the benchmark rates, but they should do this, yes. But they have also the second component, which is like a credit premium, which should be embedded into them. So if we have some movement in credit yields, this means that we either have some changes in rates, yes, in benchmark rates, again, in sovereign rates, and or maybe not only and, but it could be or, we could have some change in the credit quality of the name, right? Well, if speaking easily, we can have some, for example, credit rating improvement or upgrade or downgrade, and this could also be driving our yields up and down. Okay, so in very basic stuff, I will stop here. So the coupon payments, for coupon payments, there are two actual things. First thing is actually whether the what kind of coupon the bond has. Well, the usual structure, we'll speak about different structures, but the usual structure is the fixed coupon bond, which have just a fixed rate coupon bond. Oh, sorry, coupon, and which it pays till the maturity. Now, this is the the easiest, the simplest instrument, and the one which we agreed to call the plain vanilla instrument in the fixed income class. The one more type of instruments could be the bonds with a floating coupon rate. Again, we will speak about some of them later on, but this means that the rate is not fixed, but it's floating, and it depends on some kind of index, whatever it could be. One more class is zero coupon bonds. They do not pay coupons at all. How do you receive your income from zero coupon bonds? Huh? Yes, they're sold at a discount, so you receive your income from amortization. Let's say, let's put it this way, of this discount. So the bond is priced at 80% from par value and matures at 100%. This is actually where you receive your income. One more factor to consider about the coupon payments is actually the frequency of how often they are paid. This is also important. When we will be speaking about again some approaches to valuation, we will speak how we can compare the bonds, the yields of the bonds, which have different periodicity of coupon payments. And finally, the last one is the currency. So bonds can be issued in many currencies. Issuers from different countries can issue bonds with different currencies. So the Russian issuers, they print not only bonds in rubles, they can do it in dollars. Usually they do it in dollars. They can do it in euros, and they do it in euros, sometimes in francs, sometimes in Japan yen, sometimes in Chinese currency, but it's not that often. How do you, let's look at the question from the other side. From the perspective of the issuer, how you will be trying to choose in which currency you want to attract debt financing. What you will be, for example, you are some kind of a production company. You are, for example, I don't know, Norilsk Nickel, selling metals all over the world. Will you try to borrow in Russian rubles, for example, or in dollars or in euros? Well, it's not only about bonds, it's actually also about loans, for example, or whatever kind of borrowing facility. Maybe. But you will then need not only to look into the inflation, but you will need to look at the nominal yields as well. So you will actually need to understand what is the real rate. This one way of thinking where you will actually be able to attract money at a lower rate, for example, right? But imagine that, for example, the dollar rates are attractive, and well, currently we have quite low levels of rate. Well, in the last quarter they increased, but generally they were at the record lows. And for example, okay, you are not a risk Nikit. For example, you are Magnit, Russian retailer, right? You see that dollar rates are very low. You go and try to attract money, and you're successful. You attract dollar money, and then, well, you're a Russian company doing business in Russia, and you receive revenues in rubles. You have bonds in dollars, and for example, well, the Russian troops on Ukraine, they continue to be in the Ukraine, and you have USD ruble rate coming to, well, for example, 120 rubles per $1. What happens with your ability to service your debt being effectively a ruble company? Huh? It will not cost more. Actually, you will you will have actually cash flows that are denominated in rubles. They will be twice less. Well, comparing to the amount of payments under your debt which you're expected to do, because your debt was in hard currency and your revenues, your operating income, your operating cash flows, they were in ruble, and actually they decreased twice in comparison with the hard currency. So actually, what I want to say, you're right on the one hand, or on the one hand, but on the other hand, actually the key factor to consider, being a corporate treasurer, for example, is to match the currency of your revenue, or well, let's put it this other way, of your cash flows, right, with the currency of your debt. This is actually a lot of Russian companies had a significant mismatch of the currency and debt, of the revenue and debt currency split before the 2008 crisis. But most of them stopped doing this. Still, there are some names, and we will talk about this more in the further classes, and they still struggling in some periods when we have all this instability in the Russian ruble. In previous years, actually, the majority of the names, they try to do what you say. They try to attract at lower rates, well, where they were less, where the yield was lower, right? And they just skipped this idea of the factor that ruble could be significantly devalued. It's not only a question of ruble, but just it's a question of any currency and the mismatch of the currency structure of your debt and the requirement to service it, and the source, the currency of the source which you will use to service your debt. Okay. So we will speak actually in the very last. I forgot in the when I was introducing you this course overview. I forgot to tell you about the last thing which we will discuss during the last class. We actually will speak about the practice of how the bonds are placed on the Russian debt capital market. I will share with you my real life experience working in debt capital markets team. We will discuss about some kind of particular instruments which are available on the local market and on the Eurobond market, how the issuers can practically enter the market, and what are the structures available for them. Because as of now, we speak about some general stuff. We say bond, we say just some transaction documentation here and things like this. But in the very end, we will speak about this in more details, which kind of bond we mean in particular, and what kind of transaction documentation will we need to be able to print such a bond. For example, if some of you try to trade on the, for example, try to buy in their own investment portfolio some bonds, you've probably seen some bonds with different Russian local bonds with just series numbers, Some of them say ПО, биржевые облигации, commercial papers. Some of them are just classical bonds. There is actually a lot of differences between them in terms of structure in the deal, and we will discuss this in more details. But as of now, just like a general overview, let us introduce some kind of a trust deed. This is some kind of a legal contract that describes the form of the bond, the obligations of the issuer, and the rights of the bondholders. A lot of things are embedded into this trust deed. For us, it includes all like terms and conditions of our bond issue, and one of the most important for us as those who could probably be investing into different types and classes and of bonds will be the covenant package, which is embedded into the transaction documentation, which is also part of this trust deal. Covenants lays some clauses that specify the rights of the bondholders. Actually, the covenants are not only in the bonds, they're embedded also in every loan agreement. So we say here the bondholders, but actually of the lenders. So specify the right of the lenders and any actions that the issuer is obligated to perform or prohibited from performing. The covenants could be negative or they could be affirmative. So it's a little bit easier to speak about the affirmative covenants because they are, well, I would say not less important, but they are, well, less restrictive and, well, they're usually and typically administrative in nature. What I mean here, we have some examples in the slide. So, as for affirmative covenants, the issuer may, for example, promise to comply with all laws and regulations which the issuer should comply with. He might be required to maintain its current lines of businesses, insure and maintain its assets, pay taxes as they come due. You see all this stuff with some kind of what issuer should be doing, just, well, in most cases, just according to the regulated law. So the affirmative covenants, they say what the issuer should do. That's why they're affirmative. And usually, this type of covenants, they usually, not always, they do not impose additional costs to the issuer. I mean, just not direct costs in terms of money, but, well, just some costs which could put some restrictions on its operating activities. Actually, there is some good example when affirmative covenants being, well, again, administrative in nature, they could be important still. We have a company on the Russian Eurobond market, which is called Domodedovo. Well, I believe you understand who's the issuer of these bonds. The well-known one of the three largest airports in the Moscow aviation cluster. So if you follow the history of the company, somewhere, well, in early 2010s, the key beneficiary of the company, well, was put under arrest, and, well, the company wasn't quite transparent. But this, if I'm not mistaken, happened after the company printed its, inaugural Eurobond on the Eurobond market. When you print bonds, you are starting to become like a public company, meaning that you need to, well, publish your financial statements and things like this. They didn't have any covenant on this financial statements disclosure, and this could be actually one more example of an affirmative covenant. And they did some roadshow. They, well, presented investors with their financial, operational results with their management team, but then they just stopped publishing the financial statements on their website. And this was actually some kind of a problem. On the one hand, you, for example, if you bought such bonds, you were able to receive financial statements because you could go to trustee. Trustee is actually the party, like who's involved into the bond transaction, who is serving as a, who is securing interests of the investors. It's like in the Russian law, it's called a представитель владельцев облигаций. So you can ask the trustee, and trustee will ask the issuer, and the issuer needs to provide you with the financial statements. If there is no such covenant, then, well, you will not be able to receive financial statements. If you cannot receive it, you cannot assess the company's financials, and you will be probably put in quite a difficult situation when you just cannot understand what you have in your portfolio because you just do not know how it performs. On the other hand, if you, as for example, the bondholder of such bonds, can receive the financial statements through trustee, those who do not have these bonds will have some, well, difficulties receiving these financial statements. And what does it mean? This means that you, as bondholder, if you want to sell such bonds, you will be hard to find any buyer because they just have not a transparent way of how they receive this information. So this actually sometimes might be also quite important and quite costly, but usually, as I already said, these types of covenants, they do not impose, well, additional, or let's put it the other way, significant costs to the issuer. As for the negative covenants, these are actually the covenants which we should be mostly aware of. These covenants are frequently costly to the issuer, and they do materially constrain the issuer's potential business decisions. So, how do you think? What is the most straightforward and the most well-known covenant which could be found in the any loan documentation? It's very easy. For example, you give a credit to some company in whatever form. What you mostly should be aware of. We have some answer. Sorry. Well, we have Hamzat saying interest, but actually, so you want to say that some restriction on the on the level of the debt, on the level of the leverage. Let's put it this way. You're right. Generally, you're not right in details. I would say the idea is correct. You just want to put the maximum allowed limit, yes, the cap on the company's debt burden. Usually it's done through the different ratio, usually through the debt or net debt to EBITDA ratio, but actually you can do it this way as well, but well, this is actually less. You can meet this not quite often, this kind of ratio. But the idea is true. So you want to put some kind of a cap on the company's debt burden or company's leverage. In real life practice, as I said, you usually have a net debt to EBITDA ratio. So the level which is usually stipulated in this covenant is somewhere at the range of 3 to 3.5. This is actually some kind of break-even level above which the leverage is considered high. Again, the particular number may be different, and it's a matter of, on the company side, you want to do it, or you want it to be as bigger as it is, right? On the investor side, you want it to be as as big as only possible. On the investor side, you want it to be as low as possible. So you actually need to find the balance where both sides, I mean investors and the issuer, are quite happy to proceed with structuring the debt documentation. So again, this kind of covenant may be of two types. One will be maintenance covenant, like leverage maintenance covenant, and the other type could be the incurrence covenant. What is the difference? In the Russian universe, in the universe of the Russian Eurobond market, in 2000s and in early 2010s, the majority of the issuers issued Eurobonds with the covenants which had type which is called maintenance covenant. What does it mean? It means that you as an issuer should maintain the leverage at the level not higher than the one which is stipulated by the bond documentation. So like I said, 3 or 3.5, for example. What happens? The key difference between these two types is what happens if you exceed this level. If we speak about the maintenance covenant, you could be asked by your investors to redeem the bond if you do not comply with this maintenance level. So if the leverage goes above this level of 3, the investors could come to you and ask to redeem the bonds. If you cannot do this, then you will be probably in a default mode, right? What is the difference between the second type of this covenant, the incurrence covenant? This is less costly to the issuers because what happens if your leverage is above this level? Again, let's imagine the level of 3.0. You will simply be prohibited from attracting the new debt other than the debt which will be used to refinance the already existing debt. So the difference is in the maintenance covenant, you will be required to redeem the bonds. You can be required. If investors want, this will be a trigger for them to proceed with asking you to redeem the bonds. In the incurrence type of covenant, you will not be able just to further increase your leverage. So the idea is to prohibit you from taking more leverage. Why the leverage could increase? Again, we were speaking, for example, about net debt to EBITDA ratio. It could go up because net debt could go up. Why net debt can go up? Because of, for example, higher capex, right? Or, for example, because of, well, again, because of negative free cash flow. If you want to put it simply. The second option is, for example, your net debt is relatively stable, but your EBITDA significantly goes down. It will definitely put some pressure on net debt as well, because it will translate into a lower cash flow. But well, there are a lot of uncertainties how this could be actually done. But for example, if you are some kind of a company in, for example, you are Rusal, quite volatile company operating in a volatile market and having quite high operational leverage. Small fluctuations in EBITDA, because aluminum prices are quite volatile, will significantly change your net debt to EBITDA ratio, and it can go significantly up, significantly down. So, and this is why actually the majority of the issuers try not to use this maintenance covenant, because if you even do not change your financial policy, you do not increase your capex, you do not increase your dividend payments or whatever, just small fluctuations on your key operational markets could cause a significant breakage of your covenants. If this happens with incurrence covenants, you will simply not be able to attract new debt, and this is actually what is expected, the result which you expect to receive, because you want to put a cap on the company's leverage. And this covenant is actually nowadays is embedded. This type of covenant is embedded into almost 100% of Eurobond issues, at least those who have the cap on leverage covenant embedded. So other types of covenants, probably we'll discuss them in more details in credit review. They include what kind of covenants? Negative pledges, which prevent the issuance of debt that would be senior to or rank in priority ahead of the existing bondholders' debt. Some kind of restrictions on investments, on mergers and acquisitions, on asset disposals, on other distributions to shareholders in forms of dividends, things like this. For example, this week, one of the Russian largest metals and mining companies, announced a constant solicitation to do changes in existing bond documentation, meaning that they want just to introduce changes to the existing documentation. They want to do changes to the restrictions on asset disposals, because they want to dispose their coal business into, out of their balance sheet, just to stop the ownership of this business and to pass it to the shareholders of the company itself. it doesn't matter. To do this, they need to comply with the restrictions on asset disposals, and now they need to, the current covenant package restricts them from doing this. They need to ask investors for amendments to be able to do this, and they will pay some fee for investors if investors agree on such option. So all in all, the idea here is to improve the company's financial policy and financial discipline, to use the borrowed funds for like in the absence of any like significant moves, just no significant asset disposals, no significant M&A, just organic growth through a moderate capex, and not too many distributions to shareholders, because there were cases when company attracted a significant, for example, debt, and just spend all this money, given it to its shareholders, and then the company had some difficulties just serving its debt. The idea of the covenant package is like this: for the company to use money and to in favor of all stakeholders, not only shareholders, and to treat lenders respectively. There should be a trade-off, because the idea is that you can put too many restrictions on the company with the covenant package, and it will just put too much pressure on the company, and it will not be able to do its operating business and to do some organic growth quite effectively. This is actually a way where you can be too aggressive on the covenant package, and it's actually also not a best way to proceed with. Actually, you need to find some trade-off on the covenant package to be quite strict, but not to be too strict. That's it on the covenants as of now. We will elaborate more on them when we speak about the credit things. Let's speak about bonds domicile, but let's, I believe, first do some break. Okay, 10 minutes, and let's continue. So meet you at 7:55. Хорошо? So let's continue. So let's speak about the bond domicile, and well, the how the bonds can be classified according to this. So we can have different classes of bonds. First, domestic bonds. What are domestic bonds? These are actually, well, I would say the simplest way of thinking about the bonds. When we, for example, looking into the Russian market, these are the bonds issued by Russian companies on the Russian local debt market, like Gazprom issuing bonds on the Russian bond market in Russian rubles. So these are actually bonds issued by a firm, or well, not a firm, but by some kind of by an issuer, domiciled in a country and also traded in that country's currency. The next class is foreign bonds. So these are bonds issued by a firm or other issuer domiciled in a foreign country that trade on the national bond market of another country in that country's currency. These bonds have some kind of, well, funny names like panda bonds, if these are the bonds of foreign issuers issued in China, like Matryoshka or Kalashnikov bonds, if these are bonds by foreign issuers issued, for example, in Russia. To give you more understanding on this, the foreign bonds are, for example, in the Russian local debt market, these are the bonds issued by foreign issuers. For example, if we have bonds issued by, well, Republic of Belarus or Republic of Kazakhstan, which happened last year, for example, in the local debt market of Russia and denominated in Russian rubles, this will be the foreign bonds by the foreign issuers. The same will be true, for example, for bonds issued by corporate issuers. We had, for example, Kazakhstan Timirjaly issued bonds in 2017, if I'm not mistaken, on the Russian local bond market. We have, Belarusian retailer called Eurotorg, which has already bonds traded in the Russian local debt market. So all these are the bonds from the issued by foreign issuers, and actually and issued. So these bonds are called foreign bonds. We also have Eurobonds. So these are, well, in the book, if you open some kind of, for example, Fabotse book or again CFA book, you will see that these are bonds issued outside the jurisdiction of any one country and denominated in a currency different from the currency of the countries in which they're sold. Maybe a little bit complicated. For example, for those who sit for a CFA exam, I assume they need to remember this particular wording, but for those who just want to understand what really Eurobonds are, imagine that this is actually the external debt of, for example, of local corporates. Again, for example, if Gazprom issues not local bonds in rubles, but issue foreign bonds in, for example, Swiss francs or whatever, USD dollars, somewhere outside of Russia, these bonds will be the Eurobonds actually. Despite it said that they are issued outside the jurisdiction of any one country, or definitely they are issued somewhere, so they have some stock exchange listings usually, somewhere in the Irish Stock Exchange for Russian issuers is just the usual destination. And they are also structured under some kind of an international law. Well, usually this is an English law, not the Russian law. I will send you all the slides, so if you want just to write down what is written on them, please don't do this. Just maybe if you want to write something after me, but not on what is on the slides. And finally, global bonds. These are the Eurobonds that also trade in the national bond market of a country other than a country that issues the currency in which the bond is denominated. So these are just the Eurobonds and also the Eurobonds which trade on the local bond of the country. We will speak, and you probably will I will give you more understanding when we will speak about the Russian market. Well, I will just try to describe you well, again, the Russian bond market is, let's say, approximately $500 billion in size, and $3.5 billion, well, equivalent of $3.5 billion is attributable to the local debt market, and approximately 150 billion is attributable to Eurobond market or external market. So these are two markets. And why we separate them, why we speak about these domestic bonds or Eurobonds, these are completely different markets. Well, they are moving because of different trends. They are dominated by different investors. These are, well, just different markets. But these are markets, well, which are available for issuers in different countries, and all of them can choose where to try to print their bonds, depending on the circumstances and depending on the supply factors on this particular market in each particular moment of time. So let's move on. So as for issuing entities and for sources of repayment, well, I believe it should be quite easy here, but well, let's go through still. So sovereign bonds. What's a sovereign bond? It should be issued by, well, some entity, right? So definitely they are not issued by, well, central bank, for example. Some people believe that bonds that are issued by central banks of any country, they consider it government bonds. No, they are not. Usually central banks, they are independent of the government, right? So, and the central bank bonds, they actually are usually issued in order to, well, to absorb some kind of liquidity, but not to finance the operation of central bank, right? Central bank is a key, well, regulator on the market, trying to absorb liquidity or to provide liquidity if needed to the banking sector. But its idea is not to borrow to build something or to do something, right? You can just print the money. So the central bank bonds, they are not considered government bonds. The government bonds are usually issued by the Treasury or the Ministry of Finance, and it's usually the case of the issuing country. So in Russia, it is issued by Ministry of Finance, and we will discuss in more details the mechanism, how the Minfin, the Russian Minfin is doing this, well, later on. The regional or sub-federal or municipal bonds, they are issued also by treasuries, but of their, well, issuing entity. For example, bonds of Krasnoyarsk region will be issued by the Ministry of Finance of Krasnoyarsk region, and bonds of Oklahoma State will be issued by Ministry Treasury of Oklahoma State, by some local treasury. So what is the source of repayment for sovereign bonds? Taxes, definitely. Issuing country tax receipts, different kind of taxes. So that's what we receive. For municipal or regional bonds, again, taxes. Well, mostly taxes, some local taxes, right? Those taxes which are collected by the regional budgets. Or, for example, it could be some kind of, well, could be some kind of infrastructure bonds printed to finance some kind of a big infrastructure project which is realized in some state in some region. For example, it could be, well, partly government, I mean, regional government, partly private, and it could be structured the way that bond payments are linked to receipts from this project. So this could be also a source of repayment. Corporate bonds, so they're issued by corporates. They could be issued by holding company. Well, what is corporate? It's some kind of big structure with holding companies, sub-holding companies, operating companies, and whatever. The bonds could be issued at different ways. And when we start talking about how corporate is printing bonds, we need to talk about the subordination, and we will do it on the next slide. What are the sources of repayment for bonds, for corporate bonds? Operating cash flows, right? Just what the company earns, very easy. So now, on which level the company can issue the bonds? again, as I said, this is actually a matter of speaking about the subordination, and subordination can be of two types: the structural subordination and the contractual. The contractual is the one which is well prescribed by your legal documentation. So you can issue a bond, or you can attract a debt financing in other forms, which could be senior secured, which could be senior unsecured, which could be subordinated, or it could be well preferred or common stock, for example, right? You see it on the right part of the slide. So the higher the block, well, let's say the higher the quality and higher the recovery rate should anything go wrong. So the first is like a firstly unsecured debt. Then, well, okay, just think about this as secured debt, right? Senior secured debt. Then goes the senior unsecured debt. And actually, when we speak about bonds, again, the plain vanilla bonds, they are senior unsecured, meaning that they have no collateral, and they are senior, they are not subordinated. Later on, you see going some kind of senior subordinated debt and lower and lower, right? So the subordinated debt will be subordinated relatively sorry, to well senior unsecured, and senior unsecured will be subordinated relative to senior secured debt, right? This actually could be called the waterfall of priority of payments, right? So if the company, for example, will go into the bankruptcy, first will be repaid those lenders who are on the first block. Then if something is left, then on the second block. If something is left on the third block, and so on, so on. If something is left after all the creditors are well repaid, then some money will be received by the holders of the common stock. But well, probably this will not happen because otherwise company will not be in a hard condition, and actually probably it will not be in a default, but maybe it will be in the restructuring mode. But all in all, the idea is as follows. As for the structural subordination, this is actually what I want you to focus mostly on. This is actually where we can discuss how the corporate bonds are placed, from what kind of entities it will be placed. So what is the structural subordination? If the contractual subordination is, well, just how you structure your bond issue or your loan agreement relative to the seniority of other payments, structural subordination is the way from which kind of entity you print your debt. Easily speaking, you can do it either from the holding company or from the operating company. Again, there could be some sub-holding companies and things like this, but this will maybe too complicated. And for us, I believe it's enough to discuss the level of holding or operating company. How do you think, where, if you are an investor into the bond of the corporate, right, of the some kind of corporation, let's do that this way, you will prefer to buy which kind of debt, issued by the holding company or from the operating company, and why? Let's, for example, imagine that we have some mining company which has 3 operating companies, each with EBITDA of $100 million. And so 3 operating activity, 3 operating mines, for example. All the facility is, well, each operating company has one mine, second mine, third mine. Each of them, well, processes all this ore and, well, earns $100 million of EBITDA. All of them are 100% owned by holding company, meaning that the consolidated holding company EBITDA is $300 million. No intercompany sales, nothing like this, right? So we have 3 operating companies, each earning 100 million EBITDA. Well, all of them are 100% owned by the holding company, which has a consolidated EBITDA of $300 million. The holding company has credit ratings from rating agencies. The holding company is providing a financial statement and is a public company, let's put it this way. We, as a lenders, where we want to be, on the level of the operating company or on the level of the holding company? Well, Maxim says us that we want to be at the level of the holding company, the same as you, because it is more secure, it's too big to fail in comparison to operating company entity, and coverage is definitely better. You also say holding company. Okay, this is one way of thinking, but for example, it depends on what is actually how much is the debt we want to attract comparing to the already existing debt and to the EBITDA. But for example, imagine that each operating company is not only providing EBITDA to the holding company, but we have some banks which finance each of the operating company, and you want to buy bonds issued by holding company. What does it mean? The holding company itself earns nothing. All it earns is the money which it receives from its operating company in form of dividends paid or in form of like loan agreements to shareholder. Yes. So by some way, the operating company raises money to the holding company level, but holding company level itself is not, well, it's not mining, right? It's only consolidating the results of other companies. What does it mean? If something goes wrong, or if even something does not go wrong, in order for the operating company to raise some money to the holding company level, it needs first to be in compliance with all the requirements for spending, right? It needs first to spend some capex, then it needs to pay for its own debt, and if only something is left, it can raise money. That means that the banks who will finance the operating companies, they will receive money first, and you, as a creditor to the holding company, will receive money only after they are paid, after paying to the banks and after they are raised, if something is left, to the holding company, right? So we are actually, being on the holding company level, we are actually structurally subordinate to the level of those lenders who fund the operating companies. Agree with me? What does it mean? That means that we want to be not on the holding company level, but we want to be on the operating company level, because we want to be as close to the money as possible. No? Okay. But what you said is also true, that being on the holding company, it's bigger. You can attract more money, right? And probably your debt can be big on each particular operating company, but probably it could be zero on the other operating company, right? So it depends on which particular operating company you will be given money. How you can solve this? You can solve this in two ways, actually in different ways, but two ways of thinking. First of all, you still can issue bonds from the holding company because it's big, it's consolidating all the business. It has like credit ratings, it has the financial disclosure, all things like this. But you can give guarantees from operating companies to the level of holding companies. This will actually mean that you will rank pari passu within the creditors of the operating companies. So this is one way of thinking. You are fine to go with the debt issuance from the holding company, but you give the guarantees from the operating companies. This will align. If in the preliminary discussion we said that we will be structurally subordinate to those creditors who fund the operating companies, if we structure the deal this way, then we'll be on the one level of subordination. So we will not be subordinated. We will be on the one level of seniority of payments. We will not be subordinated to the level of banks on the operating company debt level. The other way to do so is to still bring the bonds from the operating company level,
but you can give guarantees from the holding company, which consolidates all the business from other operating companies, and maybe from the other operating companies as well. But this again will depend on how your bond issue size, well, just looks in comparison with the business of the whole group and the business of this particular operating company where you want to from which you want to print bonds. For example, on the local market, again, Rusal, big company, it prints bonds from Rusal Bratsk, for example, one of its operating smelters. But it gives the company, it gives the guarantee from the UC Rusal, which is a holding company of the group, which has a credit rating from international agencies, but actually Rusal Bratsk has its own credit rating, if I'm not mistaken, and which has consolidated financial statements and which just gives the comfort of the whole group, right? On the Eurobond market, for example, Rusal prints the bonds from international companies. That's it. One more way, one step back, one more way of okay, before we do this step back, again, well, the general rule and the most easiest way of thinking is you want to be as close to the money as you can. So if there are no guarantees, nothing like this, you want to be on the operating company level. This is actually, that's it. If you are not on the operating company level, you want to have guarantees from operating companies. Usual rule is that if the bond is structured from the holding company, the operating companies who total have an EBITDA of 75% of the group will be somewhere enough. So if you're print bonds from the holding company, you want to provide guarantees from operating companies who earn 75% of at least 75% of group's EBITDA. This is considered to be some kind of a comfortable level to the investors. If we go back on the previous slide, there is also such thing as SPE or SPV. So this is kind of some special entity, and this is actually it's quite a can be used in quite a lot of different situations, but in this particular case, I want to say that sometimes there are special entities that are created, like special purpose entity or special purpose vehicle, which is expected to own and to ring fence some specific assets from the big corporation. And these assets will serve as a collateral for bonds. Well, for example, you have you're a medium quality rated company, but you have like some brilliant assets. You can effectively sold it to some kind of an SPV, and you can print bonds which will be collateralized by these assets. Given this, you will receive higher ratings, lower cost of funding, and things like this. Actually, usually this is done with the financial assets, and then it is actually called the securitization. Yes, right. And this is actually, as I told you, the usual bonds, they are senior and secured, but this will be secured bonds. And if we speak about secured bonds, what is the difference between the secured and unsecured bonds? So the secured bonds, and this is actually the case which we discussed with ring fencing some kind of assets on separate and special created SPV. With secured bonds, you have claim to some specific assets, which is called your collateral, like your zalog, which usually, again, depending on the quality of such assets, this usually reduces the risk of default and, consequently, the required yield. The unsecured bonds, these are the claims to the overall assets and cash flows of the issuer. So you do not have any particular ring-fenced assets which lie as a collateral for your bond. So So the most common type of securitized bond is definitely a mortgage-backed security, and definitely the US market is the largest market for securitized mortgage-backed securities. The underlying securities are a pool of mortgages, and the interest and principal payments from the mortgages are used to pay the interest and principal on these mortgage-backed securities. In some countries, in European countries and in Russia, for example, as well, we can have not only, for example, these like mortgage-backed securities, which are usually a ring-fenced, yes, kind of securities. When I say ring-fenced, again, these are some SPVs which are created where financial assets, for example, mortgages are sold to, and then you issue bonds which are collateralized by these mortgages. A different way to issue bonds which are also secured by, for example, the same mortgages is not to ring fence them on a separate SPV, but to create what? Just to remain them on the balance of the issuer and to issue so-called covered bonds. These covered bonds, they are similar to, well, asset-backed securities, but the underlying assets, they are segregated, but they still remain on the balance sheet of the issuing corporation. So in the first case, we were looking at the assets which were ring-fenced on some kind of SPV, just SPV created only solely for the purposes of issuing debt, which is with the underlying assets. Here we issue bonds which are issued from our originator, bank originator, and they are just contractually covered and securitized by some particular assets. Few words. We will speak in more details about the asset-backed securities if we have some time, but I'm not sure actually in this course. But a few words about credit enhancement. Actually, this is the way how you can slightly improve, like to sweeten for your investors the credit quality of your bonds. It could be internal or it could be external. A way of thinking is very easy actually. The external is some kind of additional guarantees from some, well, external parties, which could just give you some credit enhancement, like surety bonds, like letters of credit or bank guarantees. If we speak about internal measures, which are actually built into the bond structure and how you can improve your credit positioning for your securitized debt, there are, few ways of thinking about this. First is an over collateralization. This is the way where the collateral pledged in our bond structure has a value which will be greater than the par value of the debt issued, right? So if our asset defaults are quite high, we have some over collateral to have some buffer to absorb this, right? One more thing is, for example, one more way of thinking is excess spread fund. What is an excess spread fund? This is the way of structuring your bond in such a way that the yield which is promised on the bonds is less than the yield which is promised on the assets supporting your bond. So your underlying assets, they generate you higher income than the one which you pay under your bonds. Given that there is like a positive spread between these, you earn some additional buffer to absorb any asset defaults which could happen while your instrument is outstanding. Well, one more way is tranching. You can do, again, tranching is we go back to contractual subordination. You can tranche your bond into, senior tranche, second seniority tranche, subordinated tranche, and things like this. So all assets defaults which could happen on the underlying, on your collateral, will first be absorbed by the most junior tranche, and then to more senior and more senior. Again, this is a way not to decrease the risks of investors into your general bond structure, but you can reportion the risk which are taken by investors into the different tranches. So you reportion the risk into the different tranches, but the general credit risk of the whole structure is still the same, but into each particular tranche it could be different. So few words. I don't have a slide actually on this here, but I believe it's a brief overview. Few words on the taxation. So what is your income which you receive from your investments in the bonds? Interest payments, coupons. What else? No, why? It's just you receive your money back. You can have a price appreciation, capital appreciation, right? If, for example, you bought a bond on the placement, rates went down, your price increased, and this is actually capital appreciation. If you will receive, if you wait for bond redemption, actually it will be redeemed at par, and you will actually have no capital appreciation. But for example, if you sell it somewhere in the middle of the period when it's outstanding, you might have a decrease in your value or increase in your value. If you have an increase in your value, so you will have some capital gain which need to be taxed. So most often the interest income paid to bondholders is taxed as ordinary income, right, at the same rate as wage, for example, and salary income. In some circumstances, some bonds may be exempt from taxes on, for example, coupon payments, and we have such exemptions, for example, on OFZ bonds, right, on the Russian state bonds in prior periods. Actually, now they are gone from this year, and now the coupons on OFZ, they are also taxable. As for capital gain, as I said, when a bondholder sells a coupon bond prior to maturity, it may be sold at a gain or at a loss. If it is sold with a gain, the capital gain is taxed, and again, depending on each particular country, the rates could be different. But well, the general idea that is that capital gains are often taxed at a lower rate than ordinary income. Interesting thing here, and it is important to keep in mind for those who will sit for CFA exam, considers discount bonds and pure discount bonds, those which are sold with a discount, right? So as we said, your source of income will be your capital appreciation, or like your discount amortization, yes, which will result in this capital appreciation. But for tax purposes, this will not be considered as a capital gain. This will be considered as an interest income, even despite this is just an amortization of your discount, right? This is, you actually do not receive any interest payments, but your tax regime will be the one which will consider this as a tax rate which should be taken for interest payments. This is true if we speak about like the amortization of the discount. If we see significant increase in prices, so actually this will be true if our yield to maturity does not change, sorry, and our value of the bond increases just because the time passes till the maturity. But if we see some, for example, significant decrease in rates, and this will result in price appreciation, this will be different, and this will be still taxed as a capital gain. In Russia, again, we have these different tax regimes for bonds held by individuals and for those held by corporates. before the 2021, the OFZ coupons were not taxed, and capital gains on OFZ or subfederal regions were taxed at 13% tax, or 15 nowadays, right? For some group of individuals earning more than 5 million rubles per year. Starting from 2021, we have no more exemptions for coupon payments, and now OFZ coupons are also taxed. It's actually quite significant because in previous years, individual investors were quite interested into the state bonds. They opened, well, these EEs, so-called, right? Received tax benefits from the government and just in the most easiest way, just invested their money into the OFZ. Nowadays, it's not that actually attractive. As for corporate bonds that were issued after the 1st January of 2017, the coupon payments were also not treated with taxes at the coupon for coupon rates. Again, starting from 2021, all these tax exemptions are not in place, and the coupons are taxed as well as capital gains. As for companies, so the coupons are taxed at 20% rate for corporate bonds and 15% rate for OFZ at some federal bonds, and the capital gain is taxed at a 20% tax rate. Now, a few words about different bond structures in terms of how the payments are made. So these are quite very straightforward examples. The first is the most straightforward. This is a bullet structure, the one which we presumed in our discussion of plain vanilla bond instruments. And so what does it mean? It means that we have some periodic interest payments in forms of coupons, but we have some principal payments, so-called balloon, because it's like big, a balloon payment at the very last day of the bond outstanding, and this is actually the most straightforward and plain vanilla instrument. You see that we have here a 5-year bond with $1,000 par value and 5% coupon rate, which is paid annually, and you have all this payment schedule which is shown on the slide. We can also have a fully amortizing bonds where we have periodic payments which include interest and some repayment of the principal. So we see that all the payments which should be received by the investor in the course of while the bond is outstanding, they are made with equal payments each year. There is partly interest payment and partly the amortization of the par value. And actually, in the very last table, you see a partially amortizing bond. It is, well, similar to fully amortized, but there is a balloon payment in the end, remainder of the unamortized principal. But the rest of the principal, again, as in the second case, is amortizing in in an even payments in the course of the while the bond is outstanding. So now few words on different coupon structures other than fixed coupon bonds. So prior to this, we mostly discussed fixed coupon bonds, and we said that this is the easiest structure. We know the coupon rate, and we receive a stable payments each coupon period, which is taken from its par value, which is also known and which is also fixed. But the situation can be different, and we can have different coupon structures where a coupon rate is not fixed. So the first is a floating rate notes. This is the case where we have some coupon rate, which well generally usually consists of two parts, some kind of reference rate and some margin. In this case, margins are usually fixed, while the reference rate is actually floating, and this is why this is called a floating rate note. Usually, the reference rate is some basic rate in the currency of the bond. If we take, for example, ruble bond, I would say it will be some kind of a money market rate like RONI rate. It can be different, but usually it will be RONI rate. If we speak about well USD bonds, it will be LIBOR as of now, or some new rate which comes to change the LIBOR rate. But still, it will be some basic rate in the currency in which we operate. It will usually have payments which are aligned with the periodicity of the reference rate. For example, if we take 90-day LIBOR, then we will have quarterly payments. They will be reset depending on periodicity of the reference rate. We can take 1 month LIBOR, we can take 90-day LIBOR, we can take 180-day LIBOR, whatever, but usually they will be aligned. What is important here? Imagine that we have some fixed coupon bond, and this fixed coupon bond, for example, 5-year bond. Again, our usual example. Our 5-year fixed coupon bond issued at the par value. We will show it later on, but well, it will trade with a yield to maturity equal to its coupon rate if the bond is traded at par value. If the rates, for example, 2 years from the placement date, yields declined and now trade at some, let's say, at the level of 3%. So our bond will be trading at the premium to a par. Well, we can calculate and we will do it later on. But we still will receive coupon payments which are fixed, right? Even despite the market rates 3%, we will receive a 6% coupon rate. If we want to buy or sell such a bond, well, 2 days from the placement, we, as for example, a new investor who is going to buy this bond, we will receive a bond paying a 6% coupon, but well, the rates are 3%. What will happen? We will buy it with a premium, but it will be redeemed at a par value. So we will receive a higher coupon payment, but we will, let's say, lose our money on the decrease of the price till maturity, right? Because it will be matured at 1,000 par value. If, for example, the rates go different way, for example, they were 3% and 1 year passes and the rates are now 10%. So again, our price will go significantly down, for example. What I want to say is that we have quite sensitive price to changes in yields, which is essential. If we have a floating rate note, our price fluctuations from the par value will not be significant. Do you understand why? Each coupon payment, our coupon rate will be reset and will be set to be aligned with the market rates at this period of time. This means that our bond price will not fluctuate significantly, right? If something significant changes, it can, but generally it will be significantly less sensitive to rate changes, because each coupon period it will be reset to align with the market rates, right? So generally, during the tenor of such a bond, you will be trading somewhere close to par value, and at the each coupon payment you will be trading at par value. So these bonds could be attractive for those kind of investors who are either sensitive to, well, significant fluctuations and, well, requirement to reassess their holdings, or to those investors who want to align their asset and liability side if they're linked to the same rates. Well, usually these floating rate notes, they are, well, mostly, for example, if you take a Russian market and you take OFZ, you have different classes. Some of them are floaters, meaning that they have not fixed coupon rate, but they have floating rate. This floating rate is linked to the 1-year rate, which is a money market rate. Such bonds, they are dominated by banks. Almost only banks buy these bonds. Because, well, generally, by buying them, they have no interest rate risk, right? The interest rate risk, and they are sold actually with some premium, with some margin to market money rates, meaning that they have no interest rate risk, but they receive some, well, some positive margin, taking no risk, and, well, taking no pressure on the capital, at least if these bonds are held at the held to maturity portfolio. So these bonds also could be attractive for those investors who expect the rates to go up. We have a one more option of floating rate notes. These are called variable rate notes. They're similar to those, and this is some kind of a theoretical difference. But here we have not only the reference rate, which is not fixed, but we also have a margin, which is also not fixed. So both components of the coupon rate could be different. In this case, usually in the bond documentation, you can have caps and floors, meaning that you can have well, maximum and minimum levels, which which could happen under different circumstances. Well, definitely the caps, they benefit the issuer, so they limit the highest possible coupon rate, and the floors, they benefit investors so that it will not go significantly down. What is important here? Think about this. What could change? Okay, we have the reference rate. Reference rate is like some benchmark rate, and it well, changes because of like some economic shifts and the changes in the economic situation, right? What could change the margin usually? Why the margin could be fluctuating? Imagine we have, for example, a corporate bond, a corporate variable rate note. So we will have some, for example, reference rate changing, yes, well, and we will have some margin changing. Why, for example, you think the margin could change? Because, for example, of the changing of the credit quality of the company. Can it be so? Why not? For example, Rusal, again, who went through quite significant debt restructuring in 2009 or 2010, somewhere these years. Well, it was too long ago. They had the restructured debt. If I'm not mistaken, it was not in form of bonds, but it was in form of PXF, pre-export facilities, which was linked to LIBOR rates and had some margin, which was linked to the company's net debt to EBITDA ratio. For example, if net debt to EBITDA is from 1 to 2, the margin is 100 basis points. If our margin, if our leverage is from 2 to 3, for example, our margin is 200 basis points, and so on. So the higher your leverage, the lower your credit quality. Let's put it this way: the higher the margin, right? So on the one hand, it's quite essential. Why not? If the company is more risky, the company needs to pay more for its debt, right? But what is important here? Important here is that the company is already in a worse financial condition than it was previously, and well, its leverage is increasing. But if leverage is increasing, you want to increase a higher debt burden, a higher interest payments on her, on the company, meaning that the situation is already bad and you want to make it even worse because you try the company to pay more when it actually needs help. So you need to be quite cautious here, because you can put the company in such a situation that it will be actually required to do through the second debt restructuring following this. What else? So step-up coupon bonds, actually not presented on the local market, but let's just discuss a few details. These are the bonds which are structured so that the coupon rate increases over time according to a predetermined schedule. So typically, these step-up coupon bonds have a call feature that allows the firm to redeem the bond issue at a prescribed price at each date when the coupon is increased. If the new higher coupon rate, which is increasing over time, but according to initially known a predetermined schedule, if this new higher coupon rate is greater than what the market yield would be at the call price, the firm can call the bonds and retire them. This means that if market yields rise, a bondholder may in turn get a higher coupon rate because the bonds are less likely to be called on the step-up date. What else? We can have, for example, credit-linked coupon bonds. These bonds can have a coupon rate which will go up or down depending on how the credit quality of the company changes. So, for example, different ways, you can have different ways to assess the credit quality of the company, but one of them is definitely just looking on the credit rating of the company. Put it simple, if the credit rating falls, the coupon go up. If credit rating is upgraded, then the coupon can go down. Actually, again, you should be cautious with such structures because the same as with increasing margins when the credit quality goes down. So if rating falls, and meaning that the credit quality deteriorates, a higher coupon could harm company profile even more. One more type of structuring the coupon payment is issuing a payment in kind bond, payment in kind, то есть платим в уме, which allows the issuer to make the coupon payments by increasing the principal amount of the outstanding bonds. So the coupons are not paid in forms of cash, but they are paid in form of increasing the par value of the bond. You can do it either by just increasing the par value of the bond, or you can do it just by issuing more bonds. It depends. But the idea is that you have no cash from the perspective of the corporate issuer. You have a no cash outflow to pay the coupon, but you will pay this coupon sometime after when you redeem the bonds, because you pay the coupon just increasing the future obligations in form of the amount of money you will need to redeem. These bonds, these bonds are usually issued by the companies in some distress mode, because otherwise, why would you try to sell such bonds? And these bonds typically have higher yields because of a lower perceived credit quality due to these cash flow shortfalls, or just maybe simply higher leverage of the issuing firm. For investors, actually, they don't like when the companies issue such bonds, because this actually sends like a sentiment, sends a signal that, guys, we do not want to pay your coupons because, well, we have some problems with, for example, cash flows on, a 3-year horizon or whatever. So it's just a not very good signal to the market. And this is actually why the market will usually require a higher yield on such bonds. Similar structures, well, deferred coupon bonds or split coupon bonds. In this form of bonds, regular coupon payments do not begin until a period of time after issuance. So these are issued by firms that anticipate cash flows will increase in the future and will allow them to make coupon interest payments. So in some form, they are well similar to these payment in kind bonds, but well just with some delay with coupon payments. And finally, again, a lot of different well structures could be discussed here, but there is one big group which is an index-linked bonds, meaning that these kind of bonds they have coupon payments and or principal value that is based on some kind of an index. It can be a commodity index, it can be an equity index, it can be whatever index, it can be some statistics or whatever. How do you think? If we speak about some index-linked bonds, what is the largest group of bonds which have payments linked to some index? What is the index to which they will be linked? Huh? Well, not actual, but interest rates. It will be what will be as a result. We have an answer here from Zhao Jizan. It's actually CPI, definitely. Why? Because for the largest investor groups, for pension funds, for largest institutional investors, the key idea is to outperform the inflation, right? This is usually the key benchmark, the key KPI. So the majority of the funds, they are linked to some inflation, maybe with some premiums over this, with some margins, positive margins. We have different kind of bonds, and actually four kind of bonds which are issued and which are linked to inflation. These kind of bonds can have the following variations. The first one is indexed annuity bonds. These are fully amortizing bonds with the periodic payments which are directly adjusted for inflation or deflation. So their coupon is linked to CPI. The other group is an indexed zero coupon bonds. So as it results from their name, they have no coupon payments, but their payment at maturity is linked to CPI and is adjusted for inflation. The most probably easiest way of structuring the bond is an interest index bonds. This is the bond where the coupon rate is adjusted for inflation, while the principal value remains unchanged. But the largest group and the most popular in US, these are called US TIPS, Treasury Inflation Protected Securities. And we have in Russia the similar bonds which are called OFZ-IN or inflation linkers. These are the capital indexed bonds. Their coupon rate is unchanged, so it's fixed, the coupon rate. But the coupon payment each period is different. Why? Because the principal value each time is adjusted by the CPI index. This results in what? In that the coupon rate, as I said, it's fixed, but it is already taken from different par value because the par value is adjusted to demonstrate how the inflation is changing. This means that the coupon payments will be different, and your value at the time of the redemption will also depend how your CPI behaved. Again, this is the largest class presented by the US TIPS, and in the Russian market, it is presented by the OFZ linkers. Yeah. will depend on the CPI index, how it behaves. What is the what could be the motivation for different, let's speak about sovereigns, to issue bonds which are linked to CPI? How do you think? Actually, three different motivations. Well, a lot of different maybe, but well, the key I would say I would look into. The first one is the countries with high inflation rates. Like, for example, not now, but actually the last month again different, but for example, in the last decade, like, for example, Latin America countries like Brazil, Chile, Colombia, they just have quite high inflation. Actually, Russia as well in the first half of 2010s, right? And Russian OFZIN, they appeared on the market in 2015, the first issue, when the rates were quite high. But the CPI uncertainty was quite high, and actually what will happen next was quite high. And but you still need to attract some money, and not everybody wants to buy your nominal rates, even high nominal rates, because after adjusting for inflation, they are just not that attractive, especially relative to other emerging markets, and all the markets are global. So this actually lead to the way that the government took its own role just to pay higher payments while the inflation is quite high. In other countries, for example, in some developed countries, issuing bonds with the linkage to inflation could be a sign that, well, the government just wants to show investors that by exposing its own risk to higher inflation, yes, by linking its payments to the CPI, they just want to give more surety that their, well, monetary policy is straightforward, is strict, and will try to be targeting inflation, not to be too accommodative. Well, and in the majority of also the most developed markets, it's just a social welfare benefits associated with the inflation link, just to give liquid instruments and to provide different classes of the instruments on the yield curve, so that investors have different ways of investing their money, institutional investors, first of all. So that's it on these things. I believe let's finish today. We have 10 minutes left, but I just don't want to go further. Next time we'll start talking with embedded options. We'll finish discussing the different bond instruments, and we will talk about the bond markets. After this, I believe we will start talking about the Russian bond market, and then I believe we will have quiz on this introductory stuff. I believe it will be not the next time, but well, on the third lesson. I will discuss how we'll do it because we have online and offline. Probably do you have access to this LMS system? No, I mean, for example, if you sit in front of your laptop, LMS. No, if you sit here, I can just print it and give you on the paper. But for those you mean not everyone can attend offline? Then they will do it through LMS or Google Forms, as it is set here. But I will discuss. Okay, of course. Actually, the test is already in LMS. Just I will need to check how much will I need to spend time to transform this. Thanks, everybody. If you have any questions, please either send it or prepare for the next time, and we're happy to discuss. Да, конечно. Сейчас я закрою.